A $35 fee on a $26 overdraft repaid within 3 days works out to an annualized rate above 16,000%. Not a payday loan, an ordinary checking account, and every part of it is legal. In December of 2024, regulators tried to rein it in, capping the fee at $5 for the largest banks, a rule projected to save consumers up to $5 billion a year. The banking industry fought back. Congress voted the rule down by the spring of 2025, and it was signed away that same May. Your bank has already won the argument that its fees are exactly as high as they should be. This is a documentary account of 6 of those fees, the exact legal mechanisms your bank uses to turn a shortfall of a few dollars into a stack of charges, each one documented in a federal case, ruling, or settlement. 6 fees, all legal, all still running on an account like yours, and by the end of this list, you'll know exactly which ones to watch for on your own screen. The first fee is not a mistake. It's a design decision, and it starts with a debit card swipe the bank itself approves in the moment because the account shows enough money. Days later, when that purchase settles, other transactions have already cleared first, the balance has slipped negative, and the bank charges an overdraft fee on a purchase it already approved. Some banks even post transactions, largest to smallest, instead of the order they happen. So one big purchase clears first and pushes several small ones into overdraft that would otherwise have cleared fine. One version of this practice costs Regions Bank $191 million. In September of 2022, the Consumer Financial Protection Bureau found Regions had charged these authorized positive overdraft fees for nearly 3 years, and ordered the bank to refund at least $141 million plus a $50 million penalty. 3 months later, the same regulator found Wells Fargo running the identical scheme and ordered it to refund $205 million specifically for these overdraft fees, part of a much larger settlement. Let me say that again. 2 of the biggest banks in the country were ordered to pay back money for running the exact same trick 3 months apart. And this is not new. Between 2011 and 2013, more than 30 banks were sued in federal court in Florida for reordering debit transactions to maximize how many times a customer could be charged. The second fee shows up when a payment's already failed once. A merchant submits a charge, the account's short, the payment is declined, and the bank charges a fee for insufficient funds. Then, often automatically, the merchant resubmits that same payment a day or 2 later. It fails again, and the bank charges a second fee, sometimes a third, for what is, from the customer's side, the same transaction they never approved twice. Watch how fast that adds up. One bounced $12 subscription payment becomes $35 in fees on the first decline, then $70 on the second, then $105 on a third try, and the merchant still has not been paid. In July of 2023, the Consumer Financial Protection Bureau and the Office of the Comptroller of the Currency found Bank of America systematically double-dipping on these exact fees and ordered it to refund $80,400,000 to customers, plus $60 million to the CFPB and $60 million to the OCC. $200 million total for this practice, inside a larger action that covered other violations too. Bureau examiners had found the same pattern industry-wide, recovering more than $22 million through supervision before that case even closed. California Attorney General Rob Bonta later warned California chartered banks and credit unions that this exact practice is likely unfair under state and federal law, and urged them to review their policies. The third fee is the one banks are most comfortable charging because the federal court already said they can. Separate from the fee charged the moment an account goes negative, some banks add another fee purely for staying negative too long. Citizen Bank's disclosed schedule charges $30 if an account is still overdrawn after 4 business days, another $30 after 7 business days, and another $30 after 10 business days. In 2019, the First Circuit Court of Appeals ruled these sustained overdraft fees do not count as interest under the National Bank Act, so usury-style rate limits do not apply. Critics calculate the effective annualized cost on a small negative balance held a few days can run into the hundreds of percent. The court ruled the fee a flat charge, not a loan rate, and flat charges are legal. That is the whole point of this fee, tested and legal. The fourth fee punishes the customer for someone else's bad check. Deposit a check from a client, a landlord, a friend, and if it bounces for reasons the depositing customer could not control, many banks charge the person who deposited it, typically $10 to $19, even though they did nothing wrong. In February of 2024, California Attorney General Rob Bonta warned California chartered banks and credit unions under $10 billion in assets that charging this fee on top of surprise overdraft fees is likely an unfair business practice, noting it disproportionately hurts economically disadvantaged Black and Hispanic consumers and urging them to fix their policies or risk enforcement. It's a warning, not a finished penalty, and no fine has been issued for it. The fifth fee hits at the ATM, where two separate charges can legally stack on a single withdrawal: your own bank's out-of-network fee and the machine's owner's subcharge. Some banks have gone further, charging their own fee twice in one visit, once for checking the balance and again for the withdrawal. A class action accuses TD Bank of doing exactly that, despite disclosing a flat $3 fee per transaction, an allegation still unproven. Fifth Third Bank paid $5.2 million over claims that charged customers extra for just checking their balance, and Bank of America resolved a similar claim over balance inquiries at machines inside 7-Eleven stores for $2.25 million. Separately, JP Morgan Chase, Wells Fargo, and Bank of America paid more than $66 million combined after allegations they coordinated to keep out-of-network ATM surcharges artificially high, while Visa and MasterCard paid an additional $197.5 million over related claims. The sixth fee is not really a fee, it's the reason the other five are allowed to exist. Every banking app shows an available balance that can look higher than a customer can actually safely spend, because spending holds and unsettled purchases are not reflected in real time. A customer checks the app, sees enough money, spends it, and gets charged once the timing catches up, because the number on the screen was never the real-time truth. The Consumer Financial Protection Bureau's own 2022 guidance states plainly that charging an overdraft fee is unfair when the displayed available balance looked sufficient at the moment of spending and the fee only appears afterward. That is the exact fact pattern behind the Regions and Wells Fargo cases from the very first fee on this list. One deceptive number on a screen, 5 different ways to get charged because of it. None of this happened because a law was broken in secret. It happened in the open, in fee schedules and cardholder agreements, while regulators tried to shrink it and lost instead. That $5 cap collapsed in Congress the same spring it passed, and banks have not looked back. In 2025, the year the cap should have taken effect, banks and credit unions collected more than $12 billion in overdraft and insufficient funds fees. This was never a shrinking business, it's a growing one, and the account it grows from is yours. This is the Income Mission. Subscribe for the next investigation, because $12 billion a year does not come from 6 fees alone, and the next account quietly built the exact same way is not a bank account at all.